Welcome back to the Fun Shack Private Capital Podcast. I'm your host, Ross Butler, and today my guest is Donald H. Chu. Since 1981, Donald has been the founding editor of the Journal of Applied Corporate Finance. He was also a founding partner at consulting firms Stern Stewart & Co. He has a PhD in English and American literature and an MBA from the University of Rochester. He has written dozens of collections on finance, and his most recent book, I have here, The Making of Modern Corporate Finance, a history of the ideas and how they build the wealth of nations. We're all very used to reading macroeconomic books, which make highfalutin claims and verge into pop psychology, whereas corporate finance books and texts, of which I've read many and you will have read many, many more, tend to be, in my experience, much more about technique. And they don't often draw a line between that technique and the wider world. And you do, and it's in the subtitle, A History of the Ideas and how they help build the wealth of nations, which is obviously an allusion to Adam Smith.
Right.
But I mean, that's a big thing. And I would go further and say that some of the claims that you make speak to human flourishing itself.
Absolutely. Yes. I mean, that's one of the major themes of the book, that U.S. American-style corporate finance is one of the great world success stories of the past 40 years. And why 40 years? Because the book argues that corporate America was failing in the 1970s. It was the companies had turned themselves into bloated conglomerates that were designed to cushion the effects of the business cycle by having lots of different businesses, and they were designed to produce full employment and continuous growth. And everybody was in favor of this, local politicians, managers, but the corporate executives didn't own much stock, and the companies just ended up destroying their own value. They were unable to respond to the conditions of the 70s, to the high inflation, to the regulation, and so the 1980s saw basically a reassertion of investor power and control. Investors began to step in to break up these conglomerates and to force companies to pay more attention to their shareholder value. At one point, the S&P 500 lost half its value during the 70s. So it created this enormous difference between the potential value of conglomerates if separated and their actual market values. So it was an invitation to investors to come in and begin to break up these companies. And managers had to begin to pay attention to their investors. I mean, it was the reassertion of investor control, which was the rule in America in the 1920s, and when the largest investors sat on corporate boards. But everything that happened in the 20s through the 30s was designed to protect companies from their investors. Glass-Steagall, to separate bankers were viewed as the villains. They needed to be separate from corporate managers who knew what was best for society. The assumption was that managers know better than short-sighted shareholders, investors, what to do. Well, the last 40 years has shown otherwise, because corporate America is it's a productivity miracle of the last 40 years that has basically, and companies, there have been some down cycles, but the companies have responded and rebounded from each, and the shareholder returns to American investors have been something like 12% on average for 45 years, and that's probably double the rates of return to the UK. You can correct me if I'm wrong, and certainly the Eurozone, and Japan has been in a 30-year recession since the 1990s, and I draw the contrast between the U.S. and Japan very explicitly. Japan is what happens if you have no investor control over your corporate manager. The managers, the corporate is run to achieve full employment. You're not allowed to fire anybody, and you diversify, you conglomerate, because you want the businesses to be able to insulate themselves from the business cycle. But the net effect of this concern about full employment and risk management is that the corporations are not good at anything. They lose their core competencies, their competitive edge, and shareholders end up losing value. And the consequences of Japan, I go so far to argue, are a declining population. The Japanese population has begun to shrink since 1913, and I may be the only economist who has suggested that there is a link between the productivity of your publicly traded corporate sector and population growth. I mean, not to mention GDP.
you touch on many different things, but there's a thread that connects them all. Japan, China as well, the global financial crisis, and this phenomenon in the US in the 80s of bloated companies. And you said that there's the assumption that managers know best, let's just keep the shareholders aside. And then that was identified as a problem.
Yes.
And it's basically the agency problem.
That's right.
Isn't it?
That's right.
And so, and you know personally some of the academics who are synonymous with these discoveries. Do you want to talk a little bit about
if my
them?
book has a hero, it's Michael Jensen, who got his start at the University of Rochester. He wrote the most cited article in academic finance. It's about 150,000 cites. It's called Theory of the Firm, Agency Costs, and Ownership Structure. I'm mangling the title here. But the paper argued that there is a very large tension between the goals of corporate management and their shareholders. Managers have an excessive preference for growth, size, and diversification. It just basically makes their jobs, it increases their prestige. It reduces the need for drastic layoffs at any one time, and so but for investors, they can diversify their own portfolio, so they don't need this kind of risk management device, and they want high rates of return on capital. And they want companies to invest as much as they can in their growth opportunities, but they want to pull the money out of their failing companies as quickly as possible. And conglomerates just don't do that. Conglomerates tend to starve their growth opportunities in order to maintain their failing businesses. And this ends up being a disservice to everybody involved. The shareholders end up losing. The companies end up having to lay off people. My favorite case is Volkswagen. This is the largest German private sector employer. It's 20% owned by the government of Saxony, but they have never had a factory closing in 100 years. And they recently announced that they're talking about laying off 10% of their workers, and the workers who remain will also have to take a 10% pay cut. This was their first bid in a round of negotiations with their labor. Whereas if you compare that to GM about a month earlier, GM basically ended up giving its workforce 30% raises over the next 3 years. But GM has already gone through horrendous downsizing as well as a bankruptcy. It's the only company that failed to repay the government money to prop it up after the global financial crisis.
What's the lesson from Volkswagen, though?
Their goal is clearly full employment. The German system works on co-determination, which basically means that labor has a half a voice, or one vote for every vote of shareholders. But the pursuit of full employment and market share ends up leading to a bloated company which can't compete. And once China started to pull the rug out under Volkswagen, the company is just losing value, and it's now been forced into a desperate situation where they're going to need new funding.
So it's the same.
It's a failure of corporate governance.
Yeah. So it's the same in Japan in
yes.
from the 80s onwards.
That's right.
But do you want to explain why that's the case? What was the Japanese corporate agenda then, if it wasn't profitability of the business?
It's continuous growth. And it's full employment, and it also and companies are not allowed to pay out excess cash. The share repurchase was actually illegal until 1997. The Japanese sent a deputation over to Stern Stewart. They talked to me about whether or not stock repurchase was a good idea. And I said the problem with the Japanese economy is the capital is trapped inside the firm and has no way to get out. So managers are just going to waste it. They'll waste it on increases in market share where there's just already overcapacity. They will do diversifying acquisitions. They will just find ways to preserve growth and employment, which end up hurting everybody involved. And the interesting thing is I don't know if you saw this, but the Financial Times ran an article at the beginning of January saying that the spokesman for the Japanese Kaidan Ren, which is the business roundtable of Japan, has now reached the realization that American shareholder activists could hold the key to a revival of the Japanese economy. The spokesman for the Kaidan Ren said, "We have been in a 30-year slumber," he described the Japanese economy, "and we are inviting the Elliott managements of the world and the KKRs to come over and help us make our companies more efficient." And my argument is that this is a prescription for growth. It will cause some temporary pain and some firings, but this is going to allow for it will invite foreign capital. Warren Buffett is already beginning to invest big time in Japan. He saw some of this coming, so he's ahead of the wave. But he's investing in conglomerates. But the role of the American activist will be to come over and introduce financial discipline to companies that have been lacking it for 30 years.
Well, that sounds like, good news, and hopefully, that continues. But what's interesting is, and I'm drawing a line, what's interesting is that it's taken 30 years to realize this. Yeah. And I wonder if that's because on the face of it, the ambition of the Japanese corporate sector seems quite reasonable. We want to maintain high levels of investment. We want growth. We want employment. It's very difficult to argue against that because that's actually really what everyone wants.
Yes.
The problem creeps in when they become the focus of the executive
when you can't fire people, when you just keep people around, when when your profits your returns on capital fall well below the cost of capital, which is the investor's required rate of return. And when the pursuit of growth just ends up creating, it could create increases in earnings, but that's not tantamount to creating value.
Yeah.
And they don't understand the concept of the cost of capital. And it ends up reducing foreign investment. You should be trying to attract investors from around the world, and this, but there has been no, interest in Japanese firms because investors have no power. The understanding is if something goes wrong inside a company, the U.S. investors are going to just be sent home. We don't want you, Yankee, go home.
It's very interested in your chapter on China. You say that China are potentially in a middle-income trap.
Yeah, because their companies are not productive. They are not earning rates of return over the cost of capital. So they're not creating an atmosphere of growth in which their own people can flourish. If you're a graduate from a Chinese university, you have nowhere to go because their publicly traded corporate sector is just not, it's failing. And they're just locked in this stagnation, no growth, no productivity, and investors have no control, no power to turn it around.
But they're building and building and building. It looks like successful.
Yes, but if you build buildings that are not occupied, that nobody can afford or pay, and then you have to knock them down before anyone moves in. These statistics are all reflected in their GDP growth. But as I argue in chapter 12 of my book, GDP growth is often a mirage. It doesn't reflect, the amount of wealth, which is to me the important measure, the amount of social wealth being created. In fact, one comparison that I published, there was a book by a guy named Mike Beckley. It's called Unrivaled. It's got this American jingoistic title that we all can cringe at. But he said there's been zero productivity growth since 2008 in China, whereas the United States, 30% of GDP growth is actually increases in productivity, and that's reflected in the market caps of the companies. Chinese rates of return for equity investors have been negative since 1993 when the modern markets opened. So if you were an ordinary citizen trying to buy a Chinese publicly traded stock, you would have earned a minus 5% over that entire period. So Chinese savers do not put their money in the stock market. They put it in their local banks. Yeah. And their local banks are all state-owned, and they have required investment in local Social Security, local consumption, local health care, and they're not expected to turn a profit because they understand that their debts are going to be perpetually rolled over. So this whole notion that China has this vast hoard of wealth, the trade surplus, it's an illusion. That they just, yes, they can buy government debt because they have nowhere else to put it. Far from being a sign of, this is the mercantilist fallacy, the idea that you accumulate all the gold in the world, you're somehow richer than everybody else. Well, China does have this massive amount of capital, which they then are forced to invest in American securities because that's the best option they have. Everything else inside their borders is not productive. They have a productive private export sector, which is where all the wealth has come from. But even these people, when they take their wealth, they don't invest in their own stock market because it's a fraud. They invest it in their banks.
In what way is their stock market a fraud?
It's manipulated by the Chinese government. If they think it's too low, they will buy stocks. The companies themselves are not profitable. And as I said, the long run rates of return have been negative. So
you mentioned the IPO thing as well, whereby
the IPO scheme is one of the strangest things I have ever seen. It's like they say, okay, we are going to float this company. We're going to underprice it by a factor of 100 to 150%. And any of you lucky enough to win in this lottery, if you know somebody in the party, you will get a lot of money, and they all sell on the first day.
Yeah.
So it's
and I bet it's not a lottery either. It's,
it is the most rigged process.
Yeah.
And my friend Carl Walter, he's the guy whose chapter this is about. I met him in Hong Kong at a conference. And the guy knows more about China than anyone alive. He speaks. He's been in Beijing for 20 years of his life. He underwrote the first IPO with J.P. Morgan Chase, and he says these IPOs I just don't understand what they're for. It's a massive giveaway of the capital of the companies issuing the stock, and the state doesn't benefit because these companies don't end up prospering. Nobody wins.
It's patronage. It's a caricature of American capitalism. It looks like, because there are many ways that you can reward, loyal party
they think
officials,
they think it's a democratization of their capital markets because somehow outsiders are invited to take part in this massive giveaway, but it just ends up impoverishing the state government, and Carl has written a book called his latest book is the financial deterioration of the Chinese economy. So he looks at both the public balance. There is no public balance sheet, by the way. The last one they issued was about 3 or 4 years ago. So Carl makes up his own based on what he knows.
So, and this is why I'm really interested in your take and your hypothesis with regards to corporate finance and its link to human flourishing, because a macroeconomic analysis can't get away from GDP, for example.
Right.
And in the best case scenario, like in America or Britain, it's a very imprecise way to measure even economic growth, let alone actual prosperity. Yeah. But in China, it's something like a joke.
Yeah.
But you're building a case from the bottom up, which I find much more, and you're connecting the dots. And I think some of these dots are, America's not got it perfect because it's a difficult thing to, measure. What are we trying to measure? The kind of long-term sustainability and social value of a company. And it's like, and so that's been a process of evolution, and a lot of intelligent people have put forward ideas, and it's a moving target. Yeah. But at least we know what the target is, which is, we know that value is coming from the private sector, and we need to preserve that. But as soon as you start to dilute that and say, well, actually, no, that's not the target. What we want is jobs or growth or R&D. As soon as you do a hop, step and jump to those end goals, then the thing that creates the value in the first place gets
lost sight of.
Yeah,
I have not seen any other book
talk
about this chasm. I call it a chasm between microeconomics and corporate finance and macro. And macro is supposed to be bottoms up micro. You're supposed to be able to sum up everything in the bottom and get to the top.
No, but they don't do that at all.
And so many macroeconomists I know who became finance professors, I said, what did you learn in macro? I said, nothing valuable. I remember nothing. And the Japan tried to hire a bunch of Chicago macro economists. Around 2000, they brought Milton Friedman and a bunch of Chicago monorists over to try to solve their problem. And they said, how are we going to stimulate inflation? Well, we're going to grow the money supply, M2 or something like that.
Yeah.
They completely failed. So they just sent them packing back to Chicago. And no one seems to understand that the root of the problem is a flawed corporate governance system. No one.
Well,
I have not heard a macroeconomist make that argument.
No.
Suggest it.
I remember when I studied economics A level, there were 2 units. There was micro and there was macro. Yeah. But ever since I've been in the world of work, I think you're the first person that's even said microeconomics to me. It's like so
Is it
unfashionable.
Really?
No one ever talks about they might say corporate finance, which is effectively what it is.
Okay.
But they don't
Yeah.
talk. It's like if you're talking about economics, you're talking about macroeconomics.
yeah.
And you're probably talking about that kind of charade that is Keynesian macroeconomics, which as far as I'm concerned is basically nonsense. And it's why and monetarism, I think no wonder they all failed.
Monetarism has fallen on hard times.
But even Keynesianism, it's of no surprise to me at all that this bottom-up approach is starting to look coherent.
See, where they think they're saying something is productivity. See, macroeconomists believe in productivity, but they think their measures are accurate.
So, and you made an interesting observation about the global financial crisis in this regard, which is that, again, there were ulterior motives as opposed to the profit motive. So, for example, the politicians wanted to make housing and home ownership affordable. And so you said that I think, a market that was historically very, very safe had something like a 1%
That's right.
loss ratio suddenly went through the roof because there were other motives guiding the banks. And that made me think that,
Is that the first time you had heard that explanation?
Well,
out of curiosity?
I guess explicitly, because what people tend to do is they tend to look at techniques. So like they blame things like mark to market and they say, Enron did it first.
That did have a role.
It did, but I actually think your analysis comes first because I think what happens is you have the wrong metric, you have the wrong incentive, and that creates bad governance.
Now, the mark-to-market, I was actually thinking of in different terms. The mark-to-market is what happened when the markets disappeared, and then the regulators used mark-to-market to basically wipe out the capital. Morgan Stanley had to declare $8 billion of losses in one quarter because it had these assets which were probably going to end up being worth at least 90 cents on the dollar, were being marked at 15 cents. And that accounting gesture alone just wiped $100 billion off out of bank balance sheets. So in that sense, it was a purely accounting artifact that required the banks to raise capital instantly.
In the middle of a crisis.
Yes.
I was thinking about the other side of that coin, which is the way Enron books profits.
Okay. I don't think that played a major role in the bank crisis. I mean, what I see is first of all, I think the public sector, really deserves the dominant responsibility. They are the without which nothing of the global financial crisis, in the sense that they basically encouraged the creation of something like $4.6 trillion of substandard mortgages. I think they were Alt A's and subprime. And the way these mortgages worked is that you could, under customary mortgage underwriting, to buy a house, you have to put down 10 or 20% of the purchase price. And that's a rule that Canada has continuously maintained throughout. And Canada did not lose a bank, did not suffer at all during the global financial crisis. Nor has it, America has had 12 major banking crises in its history. Canada's had 0. There have been restrictions in interstate banking in America ever since Andrew Jackson came in, which meant that we had 50,000 banks in America because every politician wanted to have a bank in his hometown. So when there is a weakness in the economy, the whole system collapses because the links are so weak that all the small banks begin to disappear. And Charlie Calomiris has a beautiful book called Fragile by Design, The Origin of Bank Crises and Scarce Bank Credit. And he just makes that comparison. There's a good reason America's had 12 major banking crises. And it's built into the political design of the banks themselves and the political clout of every state legislator to have his own bank. And that system was not abolished until 1990, the prohibition on interstate banking. Whereas Canada has 5 large banks, and cross-provincial. This was built into Hamilton's banking system. Never had a banking crisis in 200 years, which people don't understand. And so I would argue, and Calomiris argues in his book that the main cause of the global financial crisis was these $4.6 trillion of bad mortgages, which were originated by American banks. And then they were sent around the world to Deutsche Bank, all these European banks, Japanese banks, loaded up on these, they call them crap assets. You read Michael Lewis's book, The Big Short. And then the other major contributor was bank capital requirements that were on the order of 3% of assets, which is a ridiculously low number. So it was almost, Charlie Calomiris interprets this as a game of bank bargains. In other words, the implicit bargain was, if you make bad mortgages, we will allow you to operate with 3% equity. And you put those two factors together, and you created basically a $500 billion hole in bank balance sheets. And that's the amount of money that the U.S. government ended up pouring into the system. They tried buying up assets in the TARP program. That was a failure. So then they said, let's put equity capital into all these banks. And that was the key. They basically put the $500 billion back. That restored confidence in the system so that banks would now begin buying each other's paper, and they gradually got things back on track. But the U.S., in my view, created the global crisis. It was U.S. policy. It transported it to every country in the world. Every country in the world that was buying these bad mortgages, which ended up having losses of over 10%. We still don't know what the losses were on these bad mortgages, but you multiply 10% times 4.6 trillion, you get a number close to 500 billion, and that's the number they ended up, as I said, pumping back in to support the system.
But I still think the root of the problem is similar, and it runs right the way through your book, which is political interference in the free market.
Right.
And then the reason that the global financial crisis is so difficult to diagnose is that following that, there was all sorts of strange behavior, because as soon as you mess with the free market, people respond and adapt in many ways. So, for example, okay, you had all of these terrible loans, but the European banks didn't have to buy them, but they found ways to buy them. So the inadequate capital requirements, the pie in the sky modeling, from interference in free markets comes a kind of a manipulation of how you see the world in order to just make
everybody
it
was
right
paid
somehow.
to distort. The credit rating agencies all, they had never seen mortgages with 10% losses. So no quant could look out in his crystal ball and say, "Ooh, we're going to have 10% losses on these things." They say at most we'll have maybe, if 1% is the historical average, maybe we'll have 2% losses. I'm going to go out on a limb here. No quant could ever, and so they're accused of being, mercenary, compliers with, but they're not. They were being honest. They used their historical techniques, and everybody was paid to promote this system. The mortgage underwriters were, Fannie Mae and Freddie Mac were not only encouraged by Congress, they were required by Congress to do these bad loans. So rich people would take out mortgages of 2% on a multi-million-dollar house, and if the house price went down by 40%, rich people walked away from these mortgages en masse. And that's how we got to in excess of 10% losses.
Now, I said that the root cause is political, but I would stand back and make it even more generic. I'd say the root cause, when you get away from the free markets, is not so much political, is you create vanity metrics for yourself.
Okay.
So I want to see myself as a good politician serving the people. Therefore, it's a very reasonable thing for me to want more people to have home ownership. And I'm going to ignore the economic reality and what may be the ultimate outcome of me pursuing the consequence of that. But that very human emotion of wanting to pursue these vanity metrics, I think also applies to the corporate sector and what we were speaking about in the 1980s. And so I wonder if now we might actually talk a little bit more about those vanity metrics that the CEOs of the conglomerates were using. Because I do think that's the common thread in your book, isn't it?
Well, I just make a distinction between old-fashioned corporate finance and modern corporate finance.
Okay.
Old-fashioned corporate finance basically says that the goal of the corporation is to produce steadily rising earnings per share. So that's the vanity metric, earnings per share. And there are lots of ways to produce earnings per share that end up hurting your shareholders. That was the basis of the whole Stern Stewart and Company consulting firm. Earnings per share don't count and dividends don't matter were our mantras. And so companies could produce, the conglomerate form lends itself to earnings manipulation. That's why Jack Welch produced his incredibly successful conglomerate. The role of all the financial companies was to allow him to meet each earnings target as it came. He never missed an earnings target in 20 years.
So it can work?
Well, it can, but no one else was able to make it work after he took it over. And I like to think that he ended up acquiring stupid investors. They were earnings groupies that as long as he met every earnings target, they would follow him and raise his stock price. But when this is the funniest story, Jeff Immelt, when he took over the reins from Jack Welch, he said he went around and he met the institutional investors. He said they had no idea what the company did. He said, this is on you guys. You're stupid. And he was amazed by how, complacent and uninformed. So earnings per share will attract not very sophisticated investors. You will get people that,
G's the exception that proves the rule. This whole period during the 80s and 90s and beyond, to me, it looks like the search for the correct yardstick, the correct metric upon which to judge the success of businesses and incentivize people.
And that was the foundation of the company that I was a co-founder of.
And so it started with earnings per share.
Yeah, performance measurement.
Okay, and then what did it go on to? What was
it went on to return on capital, operating return on capital. And then we invented this measure called economic value added, or EVA, which is basically it's the amount of investment multiplied by the difference between the rate of return on capital and the cost of capital. That's how much value you're creating. Again, it's the volume of capital investment multiplied by the spread, the investment spread. That's value creation. And then we model the value of the firm as a multiple of that EVA, and then we call that market value added, or MVA. And it's basically the difference between a company's market capitalization and its book value.
And the reason you can't just use a simple profit metric is that it doesn't take account of the free cash flow problem. Is that
No,
correct?
It doesn't take account of the cost of capital.
Yeah.
There's no cost measure.
Yeah.
It accounts for the interest payment, but it assumes equity capital is free. So that at bottom is the problem with the Japanese economy, the German economy. They all view capital, and the Chinese economy in spades. The capital is free. There's no cost associated with it.
So the EVA, it looks like a really sensible model to me. Why isn't everyone using it?
Well, because it was very popular for a decade. It was on the front cover of Fortune magazine in '93. We had maybe 160 clients and at our peak. And then the dot-com era came along, in which operating cash flow no longer seemed to matter. What seemed to matter was growth. And all these superstar companies emerged. And so, the value companies started to trade at really low multiples, like 5 or 6 times. That's when Warren Buffett lost his touch, and he underperformed the market because the market was focused on these growth opportunities with revenue as the sole measure, and EVA just went out of vogue. So it only became appropriate for companies that were generating steady cash flow. But if you were a company with growth aspirations, you would lose your managers, because it just wouldn't, your value creation wouldn't show up in the EVA measure because it's not in the cash flow. You were no longer if you have to be cash flow positive, unless you have a way of, or you can capitalize your expenses that you think, R&D, we capitalized R&D, for example, but you'd have to capitalize brand building, employee training. There are ways of doing this. And I have an old former partner at Fortuna Advisor who's doing just that. He's creating a better measure of EVA for growth companies, but it's one that recognizes lots of expenses as capital investment.
Do you think the answer is a formula?
I don't think it works. The fact that companies, no one has seen fit to try to design this with that ingenuity, I think, Amazon is my prototypical company, and the more value they lost every year in terms of earnings, the higher their market value became. The higher their losses, their market value would increase by multiples of that. And the reason was that they were investing in their future like mad. And for a while, unsophisticated investors would look at this and say, this is not working. This is a disaster. In fact, we were once hired.
Even sophisticated investors.
Yes. Oh, lots of sophisticated investors thought Amazon was failing around 2002. We were hired at Stern Stewart by somebody to determine if Amazon was going out of business. And we had to reassure them that no, that this company is investing heavily, and the returns on this investment they're now making, they don't show up in accounting statements, but they are going to be very good.
But is there a meta lesson that can be taken from that? It's like, because even if sophisticated investors could get it so wrong, what weren't they seeing? Or what was their mindset? Why was their mindset wrong?
Because they hadn't been forced to dig into the numbers to look at the prospective margins on each dollar of investment. They didn't really understand the business model.
So you just got to understand the actual business model. You can't just do it on a balance sheet.
You have to be a really good investor. You have to devote your life to this stuff if you want to understand a company. And Amazon basically broke the mold. They basically went in their 1997 shareholder letter. They said, look, folks, we're different. We're not managing for GAAP earnings. And if GAAP earnings goes in the opposite direction, we're investing in our future. We want you to know that. And we will share with you our investment process. But we want like-minded investors. If you don't sell our shares. We don't want you. You're not our kind. And Progressive Insurance was like that. They actually, you were not allowed to talk about earnings at one of their meetings. They had this cult of they didn't have EVA, but they did monthly broadcasts of their P&L. So we say, we just want you to see our raw numbers. We're not hiding anything. This is how much we took in last week. This is how much we think our expected losses were. And this actually came when they passed Reg FD. So they were worried about, how much of this do we have to share with our investors? They ended up finding that the volatility of the stock dropped after they started releasing monthly operating forecasts. They thought the volatility was going to increase because if you provide more information, the whole story is, quarterly earnings is terrible. That's why the U.S. investors are so short-sighted, because they broadcast too often. Well, no, the answer is, if you broadcast and commit to broadcasting every month your operating P&L, you got investors who are going to support your stock. They're going to understand you. They're going to be confident in your disclosures. You're not converting them into accounting earnings where all the fancy manipulation takes place. They get to see for themselves. My theory about earnings is all investors really want to know your revenue, and they want to know your costs and a breakdown. They will build, every good investor builds his or her own earnings statement. They say this is normalized recurring earning. So, and how much confidence do we have in that? That will tell us what multiple to put on it.
It's a really good observation, because you're absolutely right. People go on and on about quarterly earnings and a fixation on it. But if you extrapolate it out and you say, okay, well, companies are only going to report every 2 years. Think what the volatility in the stock will be, because everyone's uncertain. They don't know what the impact on the company is, and so there's wild speculation. Transparency for sure is going to introduce.
My favorite statement by Michael Jensen is, managers may be myopic, that is short-sighted. Markets are not. But the thing is, every manager I know, or so many managers I know, think markets are short-sighted. They all think that they're going to get punished for earnings. And I remember going to Philadelphia in a round table there were a bunch of CEOs. And I said, you can change your investor base by how you talk to them. If you talk about earnings all the time, you're going to get dumb investors who will keep you on a short leash. If you say, we're not going to offer earnings guidance, you will get more sophisticated, far-sighted investors. They will be attracted by the very fact that you are abjuring earnings as your predominant measure.
It's the opposite of the cult of EPS.
Yeah, exactly.
You can manifest your own.
But you attract. It's about a dialogue with investors. Investors should be your partner. Like Warren, we all want Warren Buffett sitting on our board. And the way you attract Warren Buffett, who never talks about earnings, is by not talking about earnings yourself.
If we go back slightly, I want to talk a little bit about private equity, because we spend a lot of time talking about private equity on this podcast, but in some senses you don't see the wood for the trees. And so, as I said, your book gives like a half century worth of context. And the impression that I got is that if you look at just the AUM of private equity, it's still pretty small in the grand scheme of things.
Maybe 10% of total public?
Yeah, it's something like that. Yeah. It's people keep saying it's still smaller than BlackRock. right? The entire
Is that right?
AUM of
Okay.
of private equity.
Yeah.
I'm not sure about private capital as a total, but anyway, still pretty small.
Yeah.
But looking at the sweep of the development of corporate finance from those bloated conglomerates through to today, my impression was that even though private equity is small today and was much smaller 20 years ago, its impact on corporate governance has been huge. And I thought it's a little bit like, how much does my doctor influence my life? Because I only see him once every 2 or 3 years. It's like, yeah, but he comes in when I need him and fixes things. And that's the impression that I got from reading your book. It was like it changed the culture of corporate governance.
Well, that's what active investors in general do.
Right.
Yeah. So Michael Jensen invented this term of active investors. An active investor is somebody who buys a large position and offers strategic advice. He or she might sit on your board, but he will take a large enough position to actually express his will. And private equity is a form. Activist hedge funds and private equity are active investors. Private equity actually assumes full control.
You knew some of these kind of finance scholars like Milken and
Merton Miller.
Miller and Jensen.
I do know Michael Milken, in fact. Yes, he once offered me the opportunity to produce. I really like your journal, Don. Could you reduce it to the level of Walt Disney for me? And he came down to our offices. I said, no, Mike, I cannot reduce corporate finance to the level of Walt Disney because he is one of the world's great conveners of people.
Yeah, right.
To healthcare. Mike Milken is he's an extraordinary philanthropist and contributor to humanity. Much maligned, served 2 years of a 10-year prison sentence, which in my book was completely unjustified. It was one of the disgraces of the American judicial system. People to this day still refer.
Go on, tell me about this because I don't know.
Okay, you don't know the story?
No.
Okay. Well, do you know the fact that Boesky and Milken are generally thought of as synonymous with the criminal finance activity. So Milken was basically forced by the prosecutor Rudy Giuliani into making a confession. I mean, and his own brother was going to have to go to prison with him. Milken basically had to take the fall to protect his own brother from going to prison with him. So he ended up getting a 10-year sentence for stock parking. Stock parking used to be a misdemeanor, but Rudy Giuliani turned it into a felony, and then they never got him on insider trading. So he was
what's stock parking?
Stock parking means someone is trying to take over a company. You agree to hold the stock for them so they don't have to disclose their 13D filing. I mean, it is an insanely trivial offense for which Milken basically served 2 years in prison. And then it's after he was sentenced by the judge, all these convictions were overturned in subsequent court rulings, which never appeared in the newspapers. Of course, people didn't realize that they were groundless charges. And so to this day, when you hear the name Ivan Boesky, they will who was an insider trader who deserved every minute he spent in prison, that the two names are invariably linked. Right. And it is a great disgrace in which 99% of Americans still believe. There was a play called Junk that I saw in Lincoln Center in which Michael Milken is still vilified. And in the meantime, he led a national healthcare march on Washington. He's done more for healthcare than maybe anybody in America in terms of investment. He convenes a national conference on any imaginable social issue, immigration.
And so what would be your argument for the social good that his activities over his career, let's say, have done?
His financial activities or apart from them?
No, his financial activities.
No. His insight was that less than investment grade companies were actually creditworthy enough to support investment by public investors, the kind that need to be protected through SEC disclosures. He figured out that the rates of return from these investments they'd otherwise have to get private placements. So the rate of return that was being lost was so large that he knew he could build a market, a secondary and origination market. And it turns out, but he also, and he ended up, being borne out. The size of the market in '77 was 1 billion issuance. You want to care to take a guess at what it was in 2020? $400 billion.
I was going to say that.
$1 billion. You can give me back my crystal ball. Okay, all right. Yeah, $400 billion. And it's just been phenomenally successful. And he is the intellectual father of private credit. He basically realized that, bankers don't do this stuff very well. But if you take it into somewhere outside of the bank, i.e. private equity, they will find a way. So whenever you see private credit, this is what Drexel and Michael Milken did. You can lever up. They lever against cash flow, not against assets. Most banks lend against assets. So, and you can lever up. If you understand a cash flow, you can lever that up much higher than you can an asset. And so, and you can also reorganize it. Milken deals always knew that deals were going to get in trouble, but Milken had this exchange, 3A2 exchange offer. He could turn debt into equity with the snap of a finger because he had this network of investors who all trusted him, and they would agree to whatever he signed off on. And if one deal went bad, they knew he would make good through the next deal. So he created this instant device of turning debt into equity. And this is where he runs afoul of academic theory. Academic theory says you should not use debt on growth companies because that's going to cause them to pass up an opportunity. But Milken always felt the confidence that he could undo the thing with a snap of the finger. So he could lever up these companies, and then just when he needed equity, he would turn it into equity. But nobody else could do that. And so Drexel would make claims and promises about outsized rates of return, which if you were not Drexel, you would not get because you didn't have Milken's power to turn debt into equity.
Again, this probably comes back to the yardstick, what metric you're using, because if you're not using a metric that can accommodate all of that, like EPS without taking into account your full cap table, for example.
Yeah, well, you need EBITDA, or you need some measure of EBITDA to understand your debt servicing capacity. But you also need to understand how what is your call on other investors? Should you need to raise equity instantaneously, do you have the right to go out and grab equity out of their account? So that gives you enormous flexibility. And financial flexibility for most mortals, for normal market actors, normal public companies, is to operate with low leverage because you don't have that kind of flexibility. But even private equity itself now has been moving toward higher equity ratios. They were levered 90% in 1990. I think they're now levered, close to 50%, maybe. Something like Silver Lake calls itself a growth firm. So So private equity has gradually been expanding toward the growth spectrum where they use much more equity.
I'm going to say something quite cynical now, following your explanation of the Milken episode, which is it's almost like we live in a topsy-turvy world where if the FT and the New York Times criticize you, it's probably an indication that you're doing something good in the world. So private equity as a whole has the same problem.
Oh, absolutely.
Absolutely. And that started with the barbarians at the gates and everything like that. But reading your book, it becomes very clear that you don't want a world without private equity because it would be.
They've shown us they know how to run a company better than public equity does, or certain kinds, not high growth companies, and they can't. There are limits on the size of the firm and the amount of equity rate. The equity is really expensive. That's one thing I've learned from studying corporate finance for 45 years is the cost of equity is much more expensive than people think. And for information and agency reasons, this is Stuart Myers' argument.
So we're talking about GDP at the moment, measuring it. And
right.
Let's just continue with that. But I also want to talk about enlightened shareholder maximization and ESG, where I think we might have a disagreement, which would be nice.
Good. I look forward to that.
And shall we mention what's going on in the world right now, like Trump 2.0? And I don't know if you saw the stock markets today.
It's down again.
Yeah, but I think America is just looking like a buy.
A buy.
Really.
That's good to hear. I mean, that's my instinct too.
Is it? Right.
Yes. Yeah. No, and that's why I wrote the book. When I was writing this book 3 years ago, everybody was forecasting a recession. I think I was the only person. I was buying stock because I said, you people are all comparing America to the 70s. you all think there's no way they can weather these interest rate hikes. Well, these companies are different from the companies in the 70s. These companies know how to fight back. They're lean and mean. They're going to do very well in the face of these interest rate hikes. So, and I think I'm the only one who is right. So we had a tech recession 3 years ago. I don't know if you remember this. The U.S. tech recession ended up laying off 10% of its workforce. So that's what happened. Because you have shareholder activists, you have continuous recessions, which basically smooth out the bumps, which makes the companies flexible and ready to respond to anything. That's why we can weather a recession, or we'll avoid one altogether, because we're having mini recessions, throughout. We've been having a mini recession since 1980. Because the active investors are the force squeezing out the excesses, and no other country has that. I mean,
A lot of your book is about trying to find the right metric to measure corporate success so you can incentivize people properly.
Right.
But you get to a point where, as per your subtitle, your end goal is something like the wealth of nations, or what I said at the start, which is human flourishing. Yeah. And, we humans, we have a propensity to want to measure everything.
Of course. As we should.
But when you get to that point, what's your conclusion with regards to how you do measure these things at a macro scale and in the round? I realize you're not a macroeconomist, but you've built this argument up from the ground. Right. So where do you?
Well, I begin on the very first page of the book with Adam Smith's proposition that private sector productivity is the source of it's the fundamental source of social and economic worth. Private sector productivity pays for the health, education, and welfare and general well-being that most of us value most. Those are my opening lines. So you want some way of measuring private sector productivity. Well, GDP and GDP-based productivity are the macroeconomists' way of measuring what they take to be increases in national wealth and well-being. But I argue in my chapter 12 that these are very flawed measures of increases in value. They just mirror transactions. Who paid how much dollars for what? But there's no attempt to assign the value of those products, or what economists call it consumer surplus. How much would consumers really pay for something if they had to pay for it? And what you want to get is some measure of consumer surplus, and you just can't get that in GDP. No. Yeah. But my argument is that stock prices actually are a forward-looking indicator of this kind of productivity. So GDP stats are a deeply lagged indicator. I mean, they will be the last to know. As Robert Solow said, we have productivity here everywhere, but in the productivity statistics themselves. I see it everywhere around me. This is Robert Gordon's argument was America had lost its productivity. And Adrian Wooldridge wrote a book with Alan Greenspan 3 years ago. They said America's lost its mojo. In 2019, it remains to be seen if America can get back on its feet. And we've clearly seen a resounding success. And I would argue, and I do in the book, that stock prices are a much better indicator of productivity and national flourishing. And people will say, well, that money is just owned by stockholders, and they're just wealthy people. But that money gets redistributed in all kinds of ways that you see. You just reflect it around. I watched an American football game, and the people who pay these sums of money to go, $8,000 to go to a Super Bowl, all these Philadelphians from my home city, not very well behaved, are wealthier, much wealthier than they ought to be, in my view.
The trickle down.
Yes, and trickle down is a torrent.
Yeah.
It's not a trickle.
Yeah. And, so the stock market is a forward-looking indicator of
productivity. And I can't get people to agree with that. They will say, "Well, I've never thought of that before." But
the problem is that it's not perfect, and that's what people can't get beyond.
It's right. Something's not volatile, and it can. If Trump can destroy $2 trillion in 2 days, how could we trust this? Well, I'm looking at it for 45 years. Yeah. It's a 12% return on equity, which is a magnificent accomplishment. But Paul Krugman would say, no, we don't look at stock prices. They're unreliable.
So the problem with all of this is that whether it's EVA or EBITDA or whether it's GDP, it's the question of how to value, it's how to value the social good. Is there any way of valuing social good?
if you just look at.
From a corporate perspective, I mean, as an individual business.
Well, no, then I'd use the market cap. I mean, that's the best thing I can think of, supported by another measure. And I'm going to ask you a question here. What do you think is the measure that is most highly correlated with stock market values? In 1970, the measure was earnings. It had a 50% statistical correlation, 5-year moving average of earnings versus stock price. What do you think? There is a measure today that has a growing, strengthening correlation with the movement of stock market values. It's actually two measures, but sort of related.
Yeah, so it's going to be. Is it R&D as a proportion?
It's R&D as a proportion of assets is half the story, and that number in America has grown through the roof. I mean, it's been R&D as a percentage of assets is something like 20%. It's grown from 1% to 20% in the last 50 years. Yeah.
Okay.
Yeah. And the other measure, you won't guess this. This is SG&A. The increase in SG&A, selling general administrative expense, it's got everything in it. It's got training expense, marketing and branding, promotion, everything Amazon does. It's not a warehouse. Yeah, it's investment in intangibles, basically. I mean, along with R&D.
Yeah.
So if you take the increase in that number and you add it to the increase in R&D, the statistical correlation with stock prices is really good.
Well, that makes a lot of sense, really, doesn't it? Because if you invest...
Because you're willing to spend money,
right?
And you're not reporting any earnings. See, this stuff is all expensed. So what you're saying is, I trust the market to see that I'm creating value because there's no evidence in the accounting statements. These numbers are reducing your earnings, but the market is interpreting your spending as a value-creating act. This is the new form of investment. Macroeconomists always say, "Oh, American investment is falling. Americans are short-sighted and never invest in their future." Well, if you look at this measure, by that measure, American companies have been investing hugely. So if you want one metric, look at R&D budgets and SG&A, and that will be your clue to how things are going and the payoff from it.
So we're agreeing more than I thought we would, but let me try and put a wedge between us. So talking about ESG, and you also mention Michael Jensen's idea of enhanced shareholder.
Enlightened value maximization.
Yeah. It's still kind of shareholder focused, but you're trying to take account of other factors. And for me, that's not very far from ESG. And in fact, I was on a podcast with Simon Whitney, who's a well-known.
I know Simon.
You know Simon?
Yes, I do. Yes,
well-known private equity and sustainability lawyer.
I published him.
Oh, right. Yeah. And we didn't have a chance to really go into this because we were talking about something else. But I said that profit is the best measure of corporate sustainability or the good that companies do in the world. And he was diametrically opposed to that. And I said, well, what's your measure? And he said it's not a single factor. It's multidimensional. You have to take into account all of the things that the ESG agenda would take into account. And but I'm still sticking by my guns because having read your book, I think that ESG takes us down the same road that the GFC did with, wanting to everyone to have their own house.
It could.
And for Japan to want to have full employment. And it's all of these, they're virtue signals, which they're not bad in themselves, but they are the result of managing a business well. They should not be the yardstick for whether you are managing a business well.
Okay.
Now,
I think both of you are right. So I have this term called the magic of finance capitalism in the book, which is the willingness of investors to assign high PE multiples to investments they either think are going to produce high rates of return or they approve of them socially. And one of the reactions, the interpretations, is that this ends up conferring a lower cost of capital. If investors like what you're doing socially, they will view it as a risk management device. You are less likely to be interfered with by government and political regulators, and they like what they're doing. Those two factors give you a lower cost of capital, which means you have a higher price earnings multiple on the same stream of earnings. So there is a form of magic here in which you can get rewarded. So if you look at Exxon, which is probably the most demonized company in America, well, recently they have made large investments in lithium, blue hydrogen, and carbon sequestration. And I would argue that those investments end up, and they avoided renewables, which BP did, which was a huge mistake. BP destroyed almost half its value by getting into renewables, which they knew nothing about. But Exxon said, what do we know how to do, and which of those things affects society in a positive way? We can do lithium mining because that's like oil. So we're doing both good and well at the same time. So we always have our eye on long-run value maximums. I hate the term profit. The social obligation is not profit. The social goal of a corporation is long-run value maximization.
Yeah, but it's a bit wordy. I know what you mean.
It's the whole stream of earnings.
Long-run value maximization.
Yeah, that is the corporate mission. And Milton Friedman blew it, And some people insist that no, Milton Friedman didn't mean long-run value maximization, which I say that makes absolutely no sense at all. That if Milton said that, then he was wrong.
Well, the trouble with people's interpretation of Milton Friedman is they read his New York Times article like 600 words, and they don't read his 800 word.
You got to substitute for profit is long-run value maximization.
Okay, well maybe I should have
long-run series of earnings.
Yeah, I should have the discipline to say it in long form then. Yeah. One of the interesting things about your book is I wouldn't have imagined this, but a lot of the way things are done in corporate finance today was really the result of kind of a consensus following a battle of ideas between a small number of relatively unknown outside of our circles finance scholars. And some of these people you knew actually personally. So you founded the Journal for Applied Corporate Finance in 1981. Just tell me how that came about.
Well, I was in a small internal consulting group at the Chase Manhattan Bank that was run by a man named Joel Stern and Bennett Stewart, Chicago MBAs, and our mission was to sort of bring the principles and methods of modern corporate finance, what they got from the University of Chicago, to corporate practice at the Chase Manhattan Bank, and I was hired as I was supposed to be a consultant, working on client engagements, but I turned out to be such a failure at that Joel said, to avoid having Don thrown on the street, we're going to ask him he has a PhD in English, so we'll let Don start the Journal actually it was called the Chase Financial Quarterly back then. So the mission was to take articles written by finance academics, some pretty famous like Fisher Black and Merton Miller and Tom Copeland, and translate them into English that can be read by bankers, short articles distilling the concepts. And so earnings per share don't count and dividends don't matter, why stock splits don't matter.
Have you ever run an article that you think's really changed the way things are done in corporate finance?
I think the most cited article we did was Michael Jensen's The Corporate Objective Function, Stakeholder Value versus Shareholder Value. And that basically makes the case for long-run value maximization. He basically said if you lose sight of your mission of value maximization, you're going to it's going to be competitive, it's going to be managerial confusion and competitive failure are going to result from the failure to attend to long-run value maximization as your goal. Yeah. And that's where he comes up with the concept of enlightened value maximization, which means spending $1 on every constituency who matters as long as you get $1 in return. And that's how and the function of the CEO is to provide leadership and vision. The job of the CEO is to explain to everyone in the corporation, what is your contribution and what is your expected reward? What do you expect to get from what you do? And so this ends up becoming a partnership. But he also said the corporation is not a family. We're not here to take care of everybody for life. These are temporary associations and designed it's a nexus of contracts. That was his definition of the corporation. A nexus of contracts, people coming together to do things for each other. And then when their time is complete, you part ways. You're not an employee for life. This is just not an effective operation. And, people going back to Hegel have made this point. The value of a corporation is the fact that it's a temporary associate. You don't have to be a soldier for life and give your all to the corporation. You're just there on your own terms. We're all trying to benefit ourselves, and it's a mutually beneficial association. But it's not your church, it's not your school, it's your corporation, and it could be as temporary as 2 weeks, or it could be 40 years. But it's not there to protect you for life.
I don't know what the date is. It's like early-ish March, and the stock markets have plummeted today. The Trump 2.0 has, unleashed some form of mayhem. How are you feeling about American corporate finance?
I'm having modest doubts or concerns, but I think, again, this is a rerun of what happened 4 or 5 years ago when every macroeconomist thought we were going to have a recession. People are now worried about a recession. That's what we're reading. Yeah. They're saying these tariffs are going to have such a chilling effect on corporate investment that this is going to lead to a recession. So the question is that likely to happen or not? And my Pollyanna that I am, I think American corporations just have this amazing resilience, and they will cut back where they need to, but they will make further investments where they see opportunities. They will not be deterred by some of these political, to me, American institutions are stronger than Donald Trump. Finance and economics can save America from Donald Trump. In my view of the world, they are stronger than Joe Biden. They are stronger than Donald Trump. And that is the fundamental source of social wealth. That's the theme of my book.
You've been listening to the Fund Shack podcast. It's the private capital channel for alternative investment professionals. This podcast was designed and produced by Linear B Group, a leading content marketing agency focused on financial and professional services. Thanks for listening.